All right, welcome once again. So we want to look at ratio analysis, financial ratio analysis to be specific. So let me just share my screen right away. Then we can kickstart. So you will realize that we'll be looking at 5 categories of ratio analysis of financial ratios and basic actually. Basic interpretations are needed. Basic, but you need to support them with some supporting financial um, knowledge from researchers, from academics. Okay, so you will need this. We need this as a key thing. The learning outcomes is to evaluate the financial performance of a real company. So you choose a real world company, not any hypothetical company, and use the ratio to analyze. Okay, it's ideal that you get a competitor. Now, it's not just about calculation because you get a template easily tweaked to your needs. You can always adjust it to your needs. But interpreting it is the most important thing, all right? I will not go deep into all of the dimensions. I expect you to do some personal research on the ratios, the specific ones. I will give some examples, some explanations that you kick off with the rest. And then also appreciate the need that we need some financial and non-financial, a blend of financial and non-financial metrics to evaluate the performance of a company. Let's recap what we did. We use Coca-Cola as an example in this case, but let's recap what we did. For now, we are using 3 main financial statements, okay? So the statement of financial position, which looks at the financial position at a specific time, the balance sheet, the statement of profit or loss, which looks at the revenues and expenses over a period of time, usually 12 months, the statement of cash flows, which looks at the cash inflows and cash outflows for a period of time, of course, again, over 12 months. Then there are 2 more I mentioned, notes to the account, and then the statement of changes in shareholders' equity. We said the balance sheet looks at the financial position. It will bring on board the assets of the company, the liabilities, the owner's equity. The balance sheet or the statement of financial position provides a snapshot of the company at a particular point in time. Taking a picture of someone now. The next time you take a picture, it could be a different posture. So that's what it's looking at over here. We looked at the components of assets and liabilities and equity. We mentioned that the assets could be split into current and non-current assets, okay? Current being changes within a year. Non-current would last more than a year. Usually the fixed assets, investments, which last longer than a year. The current liabilities, those which are due to be paid within a year. Non-current liabilities, the long-term loans and debts we have to pay spanning over more than a year. And then equity talks of the net worth of the shareholders, okay? So that will take into consideration their initial capital they've invested, any profits they have retained over the years, any drawings out of those for a sole trader or any payments which have been taken out of those capital. The income statement or the statement of profit or loss looks at the financial performance over a period of time, comparing the income to the expenditure, and it will result in either a profit or a loss. When income exceeds the expenditure, we make a profit. But if the expenditure exceeds the income, we make a loss. Then we give a sample structure of the income statement or the statement of profit or loss, where you typically have the revenue, take out the cost of sales, you get a gross profit. Management accounting would have used the word sales less any variable costs. You get a contribution. It's just terminologies. I always say that. Take out any operating expenses, get your operating income, add any other income, and then you get your earnings or profit before interest and tax. Any interest income, add it. Any interest expense, take it out. You get a before tax profit, and then taxes are taken off and you get a net income. And statement of cash flows, we said, has 3 main dimensions: the operating activities, the investing, and then the financing. So I would want you to look at this in depth. Notes to the account, which is also a financial statement. I always think this is to me, I think this is the most important part of the financial statement, because It communicates, it explains the numbers and tells you the basis upon which we have prepared the accounts, the period it covers. If there's a number you don't understand, this guy gives you the explanation. Ratio analysis. Ratio analysis. We typically would use the income statement and the balance sheet for the ratio analysis. Okay. Now, in performance, we want to look at three perspectives, the three F's. Okay, so efficiency. If you can use less inputs to achieve the same outputs, do it. So you hear the word doing things right. So if I can use one person to do the work of two people, use it. To achieve the same outcome, the same quality, do it. I do things right. That's efficiency. And then effectiveness is doing the right thing. So I come here, I teach accounting. I don't teach biology in an accounting class so that I can achieve the objective set for me. All right. So doing the right thing, effectiveness. Doing things right, efficiency. Then we have efficacy. So the production of results intended. You measure efficacy. The measure of efficacy assesses the degree to which inputs produced the intended results and thereby contributed to true achievement of the enterprise. It is linked with effectiveness. In assessing value for non-profit organizations or government entities, public sector, you will still meet efficiency, effectiveness, but the third one will be economy. So cut down on cost. All right. So what do investors use the financial statements for? They want to compare the performance of the company this year against last year, against the previous year, and check what have they done. Did they do well? They want to use the financial statements of the company this year or last year to compare to that of competitors, to rivals, and see, did we do well in the industry? So that's what the shareholders will normally need these financial statements for. So there is always ways you can always undertake this analysis. So you will hear horizontal analysis, year on year, check the trend, okay? And then you get vertical analysis where you pick, for example, the operating cost as a percentage of revenue, of gross profit. So there is a common sizing, which will normally run into vertical analysis. And then there's a trend analysis, which will run into horizontal analysis. And then we've got a ratio analysis. So ratio analysis have specific formulas. No one is going to ask you about formulas now because it's easy to grasp. 5 main categories of ratios will be looked at here. We're looking at liquidity ratio. So it looks at, do we have money in the short term to meet our short-term liabilities, our current assets? Would they be able to cater for our current liabilities, give and take? That's all. Profitability, like the name sounds, it looks at the measure of earning power of the company, earning profits. Leverage, you always hear gearing as well, is the same thing. So talks of solvency, capital structure ratios, whether the company is able to employ debt capital structures to finance its operations effectively. So in terms of getting loans and long-term debts and how they service it. Okay. Working capital ratios called asset management ratio will look at a measure of the annual sales to its investment in various classes of accounts, typically running across the inventory, the payables, the receivables, and even cash itself. And then we have the valuation ratios, which are used by current investors and potential investors to evaluate the current share price of a publicly held company's stocks. This is what we'll be looking at. Okay, let's run through. Liquidity, like I mentioned, at this point, we want to look at three main ratios. You express them in ratios. So if your answer is 1.24, leave it as 1.24. So the current ratio is simply saying, can our current assets take care of our current liabilities? Okay, that's all. Can a business meet its current debt with its current asset? That's all. So we look at current ratio where we use current assets divided by current liabilities. That's it. And then when we come to a quick ratio, we are looking at how quickly can we meet our short-term or current liabilities without including inventory, because inventory takes a long time to convert into finished goods before we put it on the shelves and sell on credit and chase the customers for the money. Okay, so take out those elements which takes a long time to convert into cash, inventory being the main culprit. And so it is current assets minus the inventory divided by the current liability. So how quickly can we use our current assets to cater for or to pay off our current liabilities? I'm trying to use simple English for you to understand. And cash ratio is even worse. It says that, okay, let's just deal with the cash and cash equivalent items. Assuming the receivables or the customers, the prepayments, those elements of current assets, let's ignore them. And let's take only the cash and cash equivalent. So our cash at bank, our maybe short-term investments, let's bring them together. The cash in the office. So we're looking at the ability of the firm to pay off its current assets without liquidating any other assets. Use the cash. Use the cash. So typically what you will see is that cash ratio is smaller than quick ratio. And quick ratio is also smaller than the current ratio. But there's also one thing you should note. A company that does not have inventories would always have its current ratio and quick ratio to be the same or similar. Like a service company, you'll find out that the quick ratio and current ratio will be the same. In a typical assessment or exams, or assessment essay, I would suggest you use a manufacturing company so that your analysis will be a bit more solid. Okay, all right, that's it. So we have working capital ratios. How many days does it take to convert working capital into revenue? That's all it's saying. So how efficiently the firm is using its resources, its assets to generate sales and maximize profit. So you have inventory turnover days. I'll intentionally ask you to go and research on one more thing. So inventory turnover days, how quickly do we convert inventory right into sales and sell and make money? That's all. Receivable days, how quickly do we take to receive cash money from our customers whom we have sold to on credit? That's all. And payable days, how did I say how quickly? Let me use a different word. So inventory days is how many days do we take to convert the inventory, the raw materials, into finished goods and sell and make money? Let me put it that way. How many days? Receivable days, how many days do we take to receive money from our customers, customers, our receivables? That's it. And then payables, how many days on the average do we as a company take to pay our suppliers whom we have bought goods and services from on credit? That's it. So we get closing inventory over the cost of sales. If there's no cost of sales, use purchases for inventory days times 365 days in a year. Gone were the days we use 360 days because we try to use the finance. The finance guys will normally say 30-day treasury bills, 90-day treasury bills, you see 120, 180, yes. But so they will normally try to equate the number of days in a year to be 360, but now we normally use 365 days. And then I want you to look at this cash conversion cycle. What does it mean? What does it mean? So go do that research, okay? And these are all in tenor. So I'm going to give you a hint in tenor, okay? Cash conversion cycle is simply saying that add all those days which brings in money and subtract the one that takes out money. So inventory days, we produce the goods, we sell them. How many days does it take to convert it into cash or into money? So it brings in money. Inventory brings in money. Receivable days, getting money from customers. How many days? It brings in money, positive. Payable days, how many days? How long does it take us to pay? Takes out money. So add the inventory days to the receivable days. Take out the payable days. All right. So yeah, that's it. And then you interpret. Everybody wants to take shorter days to convert inventory into into finished goods and sell and make money. So the shorter, the better for inventory days. Everyone wants to take quicker to get money from their customers. So if it is shorter, 30 days, 15 days is better for receivable days because you get in money. And most companies actually would want a longer payable date because it is like getting an interest-free money from your suppliers. So if I used to take 30 days to pay my suppliers, and now I can get 90 days. What is happening? I'm getting extra 60 days free, cash-free, interest-free money. So the longer the payable days, the better. But note, no supplier will be happy that you are keeping their money for long. They will not be happy. So they want you to pay them quickly. Pay them quickly. So you should know that to you, the company is okay, the longer payable days, but to the supplier, he's not happy. Same way, for you, the receivable days is the shorter, the better to you. You see, you are now the supplier to the customer. The customer would want to take long to pay you because he's getting interest-free money. But to you, you want it quicker. All right. Then the profitability ratios are many, but we're just going to look at about 5 or 6 here. So gross profit margin and profitability margin, the higher the better. Express them in percentages. Liquidity ratio, keep it as a ratio, 1.2. If you get 1.2 as an answer, keep it 1.2. If you get 0.95, keep it at 0.95, okay? And let me just explain one more thing here. So let's say you did a current ratio and you got 1.2. What does it mean? It means that for every $1 or £1, let me use pound sterling. For every £1 of a liability you owe, you have 1.25 assets to settle it. Okay. So that's the interpretation. Let's say you calculated and you go 1.25 as the quick ratio. The same interpretation. It means for every £1 current liabilities you owe, you have 1.25 current assets to pay for it. That's it. Okay. If it's more than 1, it's better. Let me just put it that way. If it's more than 1 in liquidity ratio, it's better. And I've explained the days here, the working capital ratio days. Okay. All right. Working capital ratios, the days. Express it in days, not in percentages, not in decimal. I mean, you can keep it in decimal, 25.5 days. That's okay. But it should be in days. Ratios, profitability should normally be in percentages. So what the formulas you see there, multiply by 100% and express it in percentages. The higher, the better. It is the company's ability to generate income relative to its revenue, operating cost, balance sheet assets, equity. Okay. So when you take a gross profit margin, these are formulas that I'll just take 2. Gross margin or gross profit margin or gross profit percentage is the same thing. It's simply the gross profit divided by margin. Margin here means sales. That's all. That's all. In class, I will explain some of these things in depth. Okay. So gross profit margin, gross. So accounting formulas are a bit easy to understand. So when I say gross profit margin, gross margin is simply the first item divided by the second item. So gross divided by margin. Margin means sales. Okay. When I see return on equity, it is return divided by equity. But which kind of return? Return means profit, income. So which kind of income are we talking about? So we'll deal with this in class. Okay. The operating margin or operating profit margin or operating profit percentage is operating profit divided by margin times percentage. The margin is 100. Okay. Sometimes you hear turnover. Turnover is the same as revenue. Okay. So on and so forth. We look at this. Return on assets, earnings before interest and tax margin, net profit margin. Easy. Let's do 2 more. So we've also got the leverage ratios. So you got a debt to equity ratio. So you see the first. So this one, some would want to express it in percentages, but it varies. It varies, okay? I'll explain 1 or 2. I would want you to research on the others, okay? So debt equity ratio, simply the total debt over total equity. It depends on where you stand. The lower, the better. Now, if the debt equity ratio is 70%, do you know what it means? If you calculated debt equity ratio and you get 70% or 0.7, it means that much of the finances which are used to run the company are being provided by lenders. We borrowed it. So technically, it looks like the company doesn't belong to us. It belongs to outsiders. We pay more. Okay. Look at, so look at equity multiplier. So like the name sounds, in a common language, this total of total assets divided by equity, the higher the better. So the equity we invested, how much assets is it generating? So if I'm getting 1 point or 2.5, it means that my equity for $1 of equity I invest, it generates. So if you go 2.5, it generates 2.5 assets. Good news, right? Good news. So it depends on where you stand. Debt equity ratio, the higher, not too good. Equity multiplier, the higher is the better. When it comes to interest coverage ratio, in fact, the higher, the better. So it is simply saying that our earnings before interest and tax, how many times can it pay our interest on the loans? So sometimes you hear finance cost as the interest expense. So the higher, the better. So if you get an answer to be, let's say 12, the answer, it should be expressed as 12 times. You get it? So debt equity ratio can be in percentage, 70%. The equity multiplier can be in percentage you want to, depends on how you explain it. So you can leave it as a ratio. So if you got 2.15, you can leave it as 2.15, or you multiply by 100 and you get 215, right? Percent. Interest coverage ratio is always expressed in times. Whatever answer I get, if you get 25, it should be 25 times. 27.3, 27.3 times. The higher, the better. If it's higher, it means that, oh, you have enough operating income to pay off your interest on those loans. Then we have the debt coverage ratio or DC ratio. Sometimes we call it that is the real leverage ratio. Okay, so it is the total debt divided by the total equity plus total debt, and you express it in percentages. The lower, the better. The lower, the better. Interpretation runs same as debt equity ratio. Okay, so what is the financial position of a company and its ability to meet financial obligations? So same as the solvency ratios. Okay, then valuation ratio, it evaluates the current share price of a quoted company or a company listed on the stock market. And it is usually of interest to current and potential investors. Okay, sometimes we call it the market value ratios. The reality here is that most of them, the higher the better to the investor. Okay, so when you take a price earnings ratio, in fact, deals with two formulas. So you have to first understand the earnings per share. So EPS, earnings per share, is the total earnings divided by the total number of shares. That's it. Earnings is expressed in monetary. When you come to price earning ratio, which price? The market price of the shares divided by earnings, which earnings? The earnings per share in monetary terms, okay? And then we have a book value per share, so total equity over total shares outstanding, again in monetary terms. When you come to dividend yield, the total dividends over the total price, and normally it's expressed in percentages. So the market price of the share, how much dividend does it yield for us in percentage wise, is a good thing. So the higher, the better investors want to see this. So I have touched on all of these formulas. This is a snapshot of all these formulas and its interpretation. You have to read more about this, okay? Now I'm wrapping up, but let's look at this. How do you do the comparison to see if the company is doing well or not? It's not just okay to get the numbers. When you get the ratios, compare it. So these are some of the analysis you should do in a typical assessment. Compare whatever you've calculated, the figures, with a budget or a forecast. Are we within? Are we falling off? We budgeted some amount last year. What is the actual result? And look out for the variances. Compare this year's performance to last year. Are we doing well? Compare our performance with that of a competitor. So Coca-Cola versus Pepsi. Are we doing well? Compare Coca-Cola's performance to the industry average. So these are the analysis you should be doing, okay? So look at the context of the business or the sector, purpose of the review, who are interested in the review you are undertaking. Is it for customers? Is it for investors, loan providers, or government? That will help you to focus on key relevant items. So depending on what the stakeholders need, you tailor your analysis to them. In ratio analysis, there are some assumptions. There are some limitations as well. The assumption is that accounting policies are consistent across each year, but it's not true. we sometimes change the policies. If you look at the notes to the account, they will tell you this has changed. The policy has changed, okay? We also think that the accounting policies are broadly similar to those players in the industry. No, somebody may be using a different depreciation method. Somebody may be using some of the years they get or reducing balance. And we are using straight line method. So that is also not always true. There's also an assumption that every company is aiming to maximize profits. And there's also the fact that inflation tax is constant across board. It's not true. Okay, so those are the those are the assumptions. Those are the assumptions. Okay, those are the assumptions. There are limitations. There's lack of detail in financial statements. Accounting policies, like I said, could vary. Asset value, some are valuing assets based on historical costs, some are using revaluation methods. Is prudence built into the figures? When we talk of prudence, don't count your chickens before they are hatched. Let me put it that way. So don't overstate your gains and your profits. Okay, and don't understate your expenses. Possible management biases could also come into play here, right? So we'll do an example, and I would want you to look at it ahead of time. Coca-Cola, who are we? And then we'll do some ratio analysis there. Okay, so download the annual report from the company's website. Identify their balance sheet, their income statement for 2016, 2017. You can use the latest accounts, okay? And then you analyze their performance, financial performance, using ratio analysis. We'll do all these 5 categories. So the liquidity ratios, the profitability ratios, the leverage ratios, working capital, and valuation ratio. Who is their closest competitor? So if you take Coca-Cola, you can go for PepsiCo, right? And evaluate the performance of that same company over time and compare. That's it, okay? Compare. So do this ahead of time. Go to their company site. You can get information from there, okay? Download their report. This guides you to where you can get their information, okay? And then working towards your assignment, select a company of your own. Which one is their closest competitor? Present them. What is the criteria you use in identifying these companies? And you use ratio analysis to assess their performance. This alone gives you 30% of the work. 30% of the work. Suggested readings, please, if you could do this, that would be great. Ahead of time. All right. So friends, I end here for this particular session, and I believe it was fruitful. Okay. Everything is easy. There's nothing so difficult. Okay. You will survive. You'll be fine. I'll see you when I see you on the other side. Bye for now.